Hi everyone, it's the Catholic CEO, Henry Kutarna. Welcome to this Catholic Business Wisdom series. Today's topic, types of financing. When you are running a business, you are going to need money that is generated from some other source than your current business, at least in the beginning. You'll either need to put your own money into it, or you'll need to borrow money, or you'll need to sell shares in your business. We'll talk about those in detail. But the idea is that it's very difficult to do what we call bootstrap a business. Bootstrapping is a concept where you use the funds generated by your company, your business, finance it. What do I mean by financing it? Well, if you are hiring employees, buying a piece of equipment to produce something, getting some tools, delivering a service, building a computer system, a website, social media, and so on, buying inputs. If you're going to make some food product, you're going to have to buy some jars or packages or labels or ingredients, recipe ingredients. And so the idea is that you're going to need to pay for things before you sell them. And so that's why, generally speaking, you're going to need money and financing to run a business. Now, there are two types of financing. Number one, your money. So you could use your savings. You could use cash that you have generated in this business or in another business. What you're saying is that you're going to use your own money to finance your business with what we call working capital, which is the money that you have to put into a business in order to buy all the inputs, pay the salaries, and do everything that you have to do to make your product or develop your service before you sell it into the marketplace and get revenue for it. That's one method, using your money. And then another method, the obvious one, is you're going to use other people's money. OPM is a common phrase that is used to describe this, other people's money. And other people's money could be loans. It could be from friends and family. It could be from banks or other financial institutions, or it could be from private investors. But the concept is it's other people's money. And those are the only two ways to finance a business. It's a rare business that can finance it on its own. If you have savings, if you're going to mortgage your house, if you're going to sell another property or a piece of land or another business, or use funds from other sources that you have, like gifts or perhaps cashing in your pension plan or other methods like that, there is a way to use your own money. It's done by a lot of entrepreneurs, and it's a tried and true kind of honorable way to do it. You finance your business, your startup, or your existing business's expansion plans by using your own money. And if you do your calculations properly and correctly, which I'll talk about at length today, you will be fine with that. It should work. Using other people's money brings other obligations and other, considerations into the picture, because if you borrow somebody's money, you're going to have to pay it back, and you're going to have to pay interest. And if you don't pay it back or don't pay your interest, there are consequences. You might lose your business, or you might have a personal obligation that suddenly legally hits you if you get sued or something like that. And if you use banks' money, it's the same thing. You're going to have to pay it back with interest, and there are all sorts of conditions and factors that you have to take into account to perform. Even if you borrow money from friends and family, or they buy shares in your business, you have a new set of obligations, because then you have partners, you have people who are that you must communicate with, you must advise, because they have interests. They have your interests at heart, yes, but so do they have their own interests at heart. They have given you their money, and so they need to have their return on that money, and they need to preserve their capital. It's a complex interplay. Let's then talk about three types of OPM, other people's money. One is debt, where you borrow from other people. And as mentioned, borrowing has some requirements. You have to pay back the principal, the main dollar figure that you borrowed, either all at once at the end in what we call a balloon payment, or during the time of the loan, the duration of the loan, on a monthly basis, let's say, or a quarterly basis, or an annual basis. and then you're going to have to pay interest. And once again, interest can be paid at the end in a lump sum balloon payment. It can be paid monthly, it can be paid quarterly or annually. It all depends on the agreement that you have. So that's the debt financing method. You're borrowing somebody else's money, and you have to make the case for that, and so on. The second type of other people's money is equity financing, where someone buys shares in your business. You sell a portion of your company. You certainly don't want to sell over 50%. You don't want to lose control, and you don't want to lose control too soon. So when you have equity financing, you're going to make a deal with somebody to buy shares in your business at a certain valuation. Those shares will be worth something. And in the beginning, if you have no income, there's a whole question about what are those shares worth. We can talk about valuation at a later point. But the idea of equity financing is that somebody's going to buy a share in your company, and therefore they're either going to be a passive investor, quiet, not seemingly caring about what day-to-day operations go, or active investor, or even an activist investor, where they take a strong interest in looking over your shoulder, monitoring what you're doing, seeking regular reports, and getting information, and quizzing you about where you're going and what the direction is, and when are we going to get our money back, and what's the plan, what's the long-term plan. This form of financing is a good one, yes, because the equity financer shares the risk with you. If the company fails, everybody loses their money. In the case of debt that we talked about a moment ago, if the company fails and you fail in your obligations, you still owe the money. And so you may have to sell assets or otherwise turn over assets to somebody who's lent you the money. The third form of OPM, other people's money, is what we call non-dilutive financing. And this is grants and credits and tax credits and any other inducements provided by governments, usually, or by bodies like an SBA or a BDC, organizations, small business administration loans, which are really under ideal or better conditions than the banks, and BDC, the Business Development Bank of Canada, where you will get favorable loans, favorable consideration, maybe a relaxation of your backup requirements, and the terms of the loan might be more generous. In summary, then, you've got two ways to finance your business, to provide the working capital that you need to grow, start, or expand. And that is, number one, your money, and number two, other people's money. And within other people's money, we have these three categories: debt, equity, non-dilutive financing. By the way, we say non-dilutive because it doesn't affect your balance sheet. If you get a grant, it's not really treated as income. It's not treated as an asset on your balance sheet, nor is it treated as an obligation or a liability on your balance sheet. It's got a special category, and it's called non-dilutive, and it's shown separately on your financial statements. So it's non-dilutive in the sense that it doesn't really have an impact on the valuation of your shares, but it does help you to get going and launch. Those are the three main types of OPM, other people's money. Now I'm going to jump into different questions that you address address in order to decide which one of these you're going to do. My first question would be, this would be like a straw man argument. Do you need financing? Yes, you do. You cannot start a business and bootstrap it using the funds that it generates unless you're willing to not pay yourself, not pay your employees, use equipment that you already have or something like that. And that's a rare circumstance. So generally speaking, the answer is you do need financing, yes. What types are there? Let's get into detail now. So one would be line of credit financing, where someone gives you what they call a credit facility, which is a commitment that you can have X thousands of dollars to draw down and use at your discretion. So you might have a $10,000 line of credit, you might have a $100,000 line of credit, which means that you can write checks on that or do e-transfers or make payments for anything you need: salary, inputs, production, facilities, equipment, and so on. And the line of credit financing could be provided by a bank, could be provided by one of these friendly agencies that we spoke about, like Community Futures, SBA, BDC. Any kind of community bank or community organization can provide you line of credit financing. And there are private financings for lines of credit as well. There are people, many investors do line of credit financing. They may help you buy inventory, they may finance your equipment, they may lease you equipment, and in many other ways they will help you obtain line of credit financing. So that's one method. You certainly will need credit cards and debit cards in your business because you can't necessarily pay for everything with cash. And there is a trend, as you can see all around you, to eliminate cash from the economy. That's a whole other topic, but the point is you will need a credit card because you have to make incidental payments and purchases, and debit cards or e-transfer cards, or a combination credit card and debit card, which is very common in the US and not so common in Canada. In Canada, it's rare to see a credit card, debit card in the same instrument. They're usually separate cards with separate features. Credit card allows you to borrow money. A debit card uses the money that you already have in your bank, and it simply transfers that money to somebody else. You might need that. You might need a lease. You might need to borrow money through a lease mechanism to get a car, a truck, a van, delivery truck, You might need to lease equipment. If you have a packaging machine, or you need a forklift, or you need tools, or you need a facility like a building or a compound of some kind to run your business. Those are often leased, and so you're going to be able to use, really it's a form of borrowing, but it's a mechanism that allows you to have the ability to borrow money through a lease mechanism. There's also inventory financing, where some entity like a bank or a private individual will buy your inventory. Let's say you're in the solar business. Well, they might buy the solar panels from China and they get shipped to you, and you pay back that particular kind of loan when you sell those panels or install them on a building. There's also angel, venture capital, family office financing. These are people that specialize in financing you. Usually it's equity, sometimes it's loans, but usually it's phases of your business. So an angel investor will come in right after the founder's money. Angel investors take the highest risk and they come in right away. A venture capital group will come in much later than angels, and they will take less risk, but they may have a lot more money for you. So you'll be able to not only kickstart your business with your friends and family money or your angel financing, but you'll be able to grow and expand it using venture capital money. So these are different methods, usually equity, but not always. Sometimes you will get private line of credit. As we mentioned a moment ago, you might have people who specialize in creating a credit facility that's private to you and allows you to draw down money when you need it, but then pay it back. And sometimes the people who do line of credit financing privately may not even be interested in your business because they let you handle the business, and as long as you're making your payments, everything is fine. But of course, the hammer will come down on you if you fail to make payments. So this is why small business is, in many ways, it's a wonderful thing, but it's also a worrisome thing, because the vicissitudes of business hit you and you can't make your payment, then you've got trouble. And so this is something to always be conscious of. It's not necessarily a negative, but it is a consideration. It is. There's another aspect of using other people's money, and that is a concept called investability. Is your business something that would attract investment? Is it actually attractive to an investor? And there are much we could say about this. There are many different facets or factors that one could take into account. If you are running what we call a lifestyle business and you're just barely making a go of it, you don't have any growth plans, you just want to buy yourself a job, as they say, to, let's say, no disrespect intended, but a plumbing business. You have 2 or 3 plumbing trucks and you have service guys running around doing plumbing work. Very rare that somebody will invest in that business, because basically what you're doing is you're buying yourself a job. You have a job, you're paying your own way, you're paying the salary of your workers, your employees, you're paying for the lease and the tools, and it's unlikely that an investor will want to do that. But an investor will want to invest in your business if there's a multiple possible. In other words, if you could sell that business in 5 years for 10, 20, 30 times what you put into it, then that's an investable business. And that, software businesses, technology businesses, there are many kinds. If you are an invest business, you will have a plan, a business plan, an acceleration plan. You will have an exit in mind. And again, that's a whole other topic. You will have an investment pitch deck, a slide show that tells the investor in a summary format what's good about your business and what the prospects and the possibilities are. We use a 12 key question format that not only gives all 12 questions that an investor will ask of you, but it lays them out in the order of how the mind of the investor works. And with 30 years of experience and hundreds of deals reviewed, I can tell you that you must have a logical, well-ordered investment pitch deck to show your investors that you know what you're doing and that you have an actual plan. You need a deal room, which is a place on the internet that's secure, that has all of your white papers, your contracts, your business plans, your forecasts, your intellectual property, patents, trademarks, copyrights, and all that. So there's a deal room, a place where, under conditions with a non-disclosure agreement, an NDA, a potential investor can look at all your documents. You'll want to make it secure so they can't take them away and copy them. But in a secure, what we call a secure deal room online, you can password protect. You can let them have access for a limited period of time, days, weeks, months, whatever, and you can help them understand all the elements of your business. This is a requirement. No one's going to put money into your deal unless you have a deal room where you reveal all sorts of information about your business. This is a brief discussion of the types of financing. In summary, we can use our money, your money that is, and number two, other people's money. And if we are using other people's money, we use either debt, equity, or non-dilutive financing. And then we have a number of considerations. If you're going to use other people's money, you must be an investable business. In order to do that, you have to have a business plan, you have to have financial analysis, spreadsheet analysis, a pitch deck, a deal room, and a whole host of other discussions that give the investor confidence that you know what you're talking about and that you're going to govern their business, their investment and your business well. It will also introduce questions of governance. You'll have to set up a board with a unanimous shareholders agreement, a USA as we call it, and you're going to have a regular process where you meet and involve your investors in perhaps in decision making, depending on what your USA says, or at the very least reporting to them on your progress and explaining yourself and developing plans and strategies for the future. So there's a lot of work involved in using other people's money, but it is a successful method. It can be done. It can be done by almost anybody. The level of knowledge required is not impossible to attain. You don't have to become a lawyer. You don't have to become an accountant. You don't have to become a tax expert. But you do have to know your business. You have to be confident. You have to show the potential growth and how that money is going to be used. Last thing I'll say about using other people's money, I'll use an angel investor. I'll use myself as an example. As an angel investor, if I invest money into 10 deals, 7 of them will, roughly speaking, fail. 70% of the deals, and this is true, I've invested in many deals, and my family has, and 7 of those technology startups, early stage companies will fail. 2 or 3 will muddle along, that you might get your money back for them, and 1 might become a home run where you get 5 or 10 times your money. And that's why an angel investor is so anxious to be part of decision making and is so careful, because if we put money into 10 deals, 7 will fail completely, a couple might muddle along, and we might get our money back, and then we have to get all of our return on all that money we spent from that one deal that will succeed. That's the mentality to keep in mind when you're talking about angel investment or venture capital or any other consideration using other people's money. Homework for you from this session, I would urge you to do some analysis for your startup idea, your side gig, or your existing business that you want to expand, add new products, add new markets, and so on. Do some analysis. Figure out where you're going to get the capital to expand. Run the simulation numbers to see how much you're going to need. You cannot ballpark this. You must know with precision that I need this month, next month, the month after, and so on. What do I need in terms of capital? Revenue minus expenses equals either profit or loss, but how much capital do I have to put in each month until I hit break even and until I hit profitability? Last thing I'll say, the concept of break even is when you actually are, producing more revenue than your expenses. But profitability is when you're actually making a return on the investment. And so the profits are such that you can calculate how much of a return you're getting on the dollars you put in. Your homework then is to consider your plans, how much money you'll need, and in order to do that, you need to do some very good spreadsheet calculation analysis. We have on our website available to you, if you want to purchase this, we have a spreadsheet analysis that's very sophisticated that will allow you to run the numbers and to do a simulation and apply it to your business situation. So take a look if you like that. And you also would want to then discuss when the money will be needed, and that'll come from your analysis and also your gut feel about your plans, how quickly, how accelerative you are going to be about your business. Do you want to do this in 1 year or 10 years? There's a lot of consideration there. And finally, you're going to, once you use other people's money, whether it's a bank or an investor, you are on a path to an exit that is not necessarily the one that you thought of at the very beginning. You might need to exit faster because the terms of your loans or your equity financings might force you to accelerate your plans. Much to consider, much to think about. An exciting world because you can use your money and other people's money to grow your business, and you can then fulfill your obligations as a Catholic business owner to take care of your family, to create a multi-generational business, to resist the culture, to be independent. It's all a wonderful path to go on, and it's one that you can go on quite well by pursuing the virtues as well as being a prudent, smart business owner, where you do the analysis, you do your homework, and you stay on top of it at all times. So there you go. Types of financing. God bless you in your business enterprise. It's the Catholic CEO, Henry Kutarna. See you next time.